FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
We are back on the Financial Survival Network. You are listening to Kerry Lutz, and we don't have to tell you all the crazy things going on in the world. What you need to do about it is really the question. If you have a chance to, you want to support the show, just go to clubfsn.com. Really appreciate anything you can do. We're looking to expand the audio and video facilities and stream it 24/7. In the meantime, everybody wants to know what's going on with gold and silver, which is why we've got Bob Hoye back on with us now. You know his site well, institutionaladvisors.com, and often see his work up on kitco.com. Bob, welcome back.
Good to be with you, Kerry, and with your listeners. And you're right. This is really fascinating times in the marketplace. And I think I'm going to use a line that I was mulling around with yesterday. And you have measurable signs of terrific speculation in the stock market and in, let's just call them junk bonds, as representing a whole bunch of lower grade bonds. And as I say measurable, that's both on sentiment figures, which have been up to numbers only seen at cyclical peaks, and you've got momentum only seen at cyclical peaks. And as we joked the other day, you can get gold and silver go from overbought to oversold and back again. And you can get a number of other commodities doing that, but the stock market goes from overbought to overbought. And
for years already.
Well, I don't mind it. Getting to 5 years was okay, and then now we're sort of 5 years plus a few months, and so the whole thing's getting rather aged. But it's not just private speculators out there. This has been accompanied by the greatest speculation in policy that we've ever seen. They've been buying low-grade bonds, particularly the Fed was buying subprime mortgage bonds with the idea that that's going to help the housing and then that's going to help the economy. And as we go back to 2009, when everything was washed out and a rebound was possible, we did one thing and said, well, maybe it might look like 1937, which would be 5 years. And then the other one was that the economy, the recovery would likely be weak. And it has, and you've got the establishment all wondering, oh, why is it not working? So then they think, well, we're not showing any CPI inflation, and they got this target of 2%, which is insane. But, they don't understand inflation in financial assets. And we've had huge inflation in stock prices and the equivalent in lower grade bond prices. Let's just cover the whole area as junk bond prices. And so they think they can still use the old recipe that easy money will prompt a strong economic recovery. And it ain't happening. And this one's getting long of tooth. So now here's one other layer of speculation that should be more widely covered, and that is the official notion that a committee of people in a central bank can manage the economy. I mean, it's absolutely absurd. But if you go back to the original formation of the Federal Reserve, it was prompted by the 2007 crash, which was the result of over-speculation. And so they looked at that, and the real motivating factor was these guys dreamt up this idea that if you could prevent a hit like 1907, then you wouldn't get a recession. So the Fed was formed to prevent financial accidents and recession. Right? There's been 19 bear markets and 19 recessions since then. So we should recognize that it's not just the Fed acting in a highly speculative manner lately. It's also the whole theory behind the intervention has been highly speculative and has been disproven by financial history not to be working. And yet these guys still have control of things. So I'm looking for a tremendous intellectual revolution here, which on when it comes in, and it's inevitable, the next recession and the next bear market for stocks, many folks out there are going to say, look at all of the huge quantitative easings and whatever you wanted to call it, didn't work. And therefore, the Federal Reserve System doesn't work. So I'm eager for that, to see that happening, Kerry.
Yeah, I mean, it's been 100 years now, and if anything, we have more instability than we had before because, right, the bubbles just seem to be getting bigger, right, Bob?
Oh yeah, it's in engineering terms, you have what one calls a negative feedback system. Now that's the real world. When in physics or weather or climate or whatever, anything gets too far done, there's always a self-correcting mechanism and brings it back to more or less stability. But with these jobs in central banking, they work on positive feedback where you keep driving what's going on even harder until the whole thing blows up. And I think the best one I remember from years ago about negative and positive feedbacks is that on steam engines, they'd have a governor on it. So as the thing got whirling around, these weights would get whirled out, and then that would slow down the steam going into the engine. So that was a negative feedback system. So then you take the governor off, and then you keep feeding steam to it. It keeps going around and around until it blows up. So this is where we are here again. And I hope on this one that the establishment gets a real proper condemnation. So but just let's take a look at it. You've had a bit of a falter in the stock market, but no major break yet. You've had, now what we're getting some interesting action in is the credit spreads. The difference between high-grade and low-grade issues has been widening. And that is one of the ones we've used going back to 2007 or 2000, and when the widening comes in, you then have a problem. You're not sure just how long after that the stock market rolls over. And what we also want to look at, Kerry, I think, is the fact that where the Fed is deluded in thinking that all it does is expand its portion of credit and it's going to get GDP growth. Well, that's not happening. But then there's also something else not been happening since 2011, and that's the gold and silver market. And in which case, the gold bugs have a similar sort of conviction that what the Fed turns the tap on, gold and silver are always going to go up. But it's the public that chooses what's going to happen. And as we've been saying, that's the S&P and junk bonds. That's where the crowd is, and it's not been in gold and silver. So we want to look back to what happened in 2011. Was it essentially a decade-long bull market for the sector ended, and that top of that bull market showed a lot of reckless dealings by some of the big companies, Barrick and all this sort of stuff, was looking at huge properties, huge expenditures, in some cases geologically risky, in other cases politically risky. So now at that time, what we use as a guide is that on any of your regular type bull markets for precious metals, silver will always outperform gold, and so then we keep track of the silver-gold ratio and momentum. And in 2011, the RSI, that's the relative strength momentum indicator, got up to 92. So we looked back and ran the charts back and said, when did this happen before? Well, that was in January 1980 when silver peaked at $49, and you went into the long crash. So when we got this in 2011, we thought that this was as dangerous as in 1980, but we didn't think it would be as bad. And when you get a bear market in the precious metal sector, it's always bad. So then there was another rally that went out to September of 2012, and on that one, the RSI on silver gold got up to 82, I think it was. And then going back down into November, where you were getting good stock market action and good action in junk bonds, but we thought that the base metals and commodities, precious metals, were kind of overdone on the downside. There was momentum things. So we called it the rotation, whereby these depressed items would probably bottom in December and then rally, which we did get. And the grains actually were delayed, and they finally came in and rallied, but lately they've been a disaster.
Mm-hmm.
But let's just take a look at the precious metals, which really rallied. I mean, I saw some junior stocks here trade from $1.05 to $1.90. Outstanding stuff. But where did that RSI get on the silver gold ratio? Well, it got up to 84. So it became another point of dangerous speculation. But on the gold itself, Kerry, this is a big-time cyclical bottoming action. And the reason why we're saying cyclical is because it's been in a decline since 2011. But the main thing is the decline was also during the time when you had a fabulous bull market for stocks and junk bonds on. And if you look back in financial history, there is a tendency for gold to go opposite to whatever the big speculation is. So when in 1929, for example, you had a big party in the stock market, a lesser party in gold shares, and the real or deflated price of gold came down, and then after that party was over, the real price of gold went up for almost 20 years, within the usual 4 or 5 year business cycle.
Sure.
And then eventually the gold producers, the profitability was outstanding, and they became the really terrific outperforming group. So this is what we're looking now, where the blowout in 2007 had some of the characteristics of 1929. I'm going to back up here for a minute and say that the big dot-com bubble in 2000 was a fabulous, insane speculation, but it didn't have the components of a classic mania like 1929. No, 2000, there was very little action in commodities, and the housing boom wasn't insane at that time. But 2007, you had fairly good commodity prices and a fabulous housing real estate boom. So you get those three together, and then it was a classic bear market crash. They said it was the worst collapse since the 1930s, and then now even the establishment recognizes it's been the weakest recovery since the 1930s.
If you want to call it a recovery, arguably, with the structural unemployment the way it is, contracting employment numbers.
Oh,
it's horrible.
They're talking about a 6% unemployment, but it is so bogus you can't believe it, because there's so many people who might be employed who are not employed and aren't even bothering looking. So it's a disaster in policy land.
Yeah.
And so here's again using a post-bubble model. The first business expansion out of a classic crash is likely, as weak as it is, it's likely maturing sort of as we speak. And the first bear market out of a post-bubble crash is getting mature as well. And then this is a bit of cyclical bull market for orthodox investments, and it's been a cyclical bear market for gold. So I think the two are going to turn against each other, and as the stock market rolls over, gold will improve. Now, we also keep track of gold against commodities. The only important commodity index, or the longest running one, is the Economist All Items, and it does not include gold in it. So we couldn't get the raw data on that one. So years ago, maybe decades ago now, we put together our own commodity index, just basically base metals, the grains, agriculturals, and energy prices. And it acts fairly closely to the Economist All Items. So we have that as a proxy for the real price. And it came down quite smartly, down to a low in the first part of June. So we want to look back when we had a low on this before, and that was in let's see, no, that was in May and June of 2007. So when gold's real price turned up, we took that as the warning on that speculation, and it did work out well. So the rise in the real price of gold turned essentially with the turn in the credit markets. In early June, I was at an institutional seminar in London and used a PowerPoint and used the images of crashing trains and said that this was the start of the worst train wreck in the history of credit, which it turned out to be. So here we are now. This has turned up, and one would expect the speculation in stocks and low-grade bonds to run into difficulty about 4 or 5 weeks later, which is where we are now. But I should also mention, Kerry, that this gold divided by commodities index works the other way, because all through the crash from 2007 to March of 2009, that gold relative to commodities went up hugely. And that set its high on February 20th, 2009. And as it came down, it was the signal that the panic in the financial markets was going to end, and that ended on March the 9th. So this guide, if you will, works at important bottoms and at important highs. And I believe it's working now, so we just have to be a little patient in here on watching for a next leg down in junk bonds and the S&P actually rolling over. Now, while gold could go up in dollar terms, it could go up actually in many currencies, because this will be the extension of the rise in real prices relative to most everything else. But it may not carry the gold stocks with it, because if you've got serious problems in the big stock market, it's going to be difficult to rally the gold stocks. And they may then, when Mr. Margin gets going, they may be used as help me.
Yeah.
Where you throw out
Bob,
the baby with the bathwater, so to speak.
Bob, what about the stock buybacks that they've been doing to artificially inflate stock prices? Like IBM's, profits have been down for years, and yet they've been buying back stock to artificially inflate per share sales and profits. And
absolutely insane.
Yeah, isn't it? It's short-sighted, and it's destructive to the balance sheet.
Well, they got corporates can junk bonds are trading at a 5% yield, so it doesn't cost you much. So they've been borrowing money to bid up their own stocks, and after the crash of 1929, at least the street and the establishment knew that the crash and the depression was caused by over-speculation in the stock market. So then the SEC was formed in 1934 to prevent over-speculation in the stock market.
Done a fine job. Fine job.
And then they also brought in Glass-Steagall to get the commercial banks out of Wall Street, and that was another source of speculation. And then Graham and Dodds published their book in 1934, criticizing the stupidity effectively criticizing the stupidity of money managers in 1929. So you had three important items that were to prevent another bubble in the stock market. And in the 1930s, when the various politicians were promoting the formation of the SEC, one of them was going around boasting that with the SEC, it would put a cop at the corner of Wall and Broad Street. And so then you had the Bernie Madoff disaster, where whistleblowers went to the SEC and they wouldn't act on it. So a very important agency that was intended to prevent bubbles and to prevent malfeasance did not work.
Well, that cop has definitely gotten very obese on all those donuts, and he's so big and fat he can't move anymore. And the thieves have just got run of the street. But so where do you think in 6-8 months silver and gold are going to be here, Bob?
Okay, well, the other thing in a post-bubble contraction is that gold will, so earlier when I said in a normal bull market for precious metals, silver will outperform gold. But when you're in a post-bubble deflation, any of the gold rallies, probably gold will outperform silver. So the silver stocks won't do as well, and you have to wait until we get past a couple of major hits to the big stock market before you can really start to seriously position in the gold. Now, one thing we really like, myself, for decades, I've always liked exploration sector. But decades ago, when you had a bear market bottom for gold, precious metals, you'd have the seniors rally for maybe a year before then the in-between size ones would get going. And then finally, near the top, you'd have a bull market, a bubble in speculative, in juniors, exploration stocks. But on this one, coming out of Christmas, hey, they all moved at the same time, and if you looked at the GDXJ, outperformed the seniors. So there is a huge market out there for the exploration side, and that's where the big action, when it comes in, will be. And so here's the wrap-up on it. Very bullish on gold in real terms. Gold could at times move up in dollar terms, but the problem in the post that we're going to get is as the big bubble in stocks and bonds deflates, the U.S. dollar will get firmer. But if on any day that the dollar is really strong, of course, gold's going to get marked down. But if you can have a quiet firming in the dollar, you could also have gold going up at the same time. But the net thing, Kerry, is the real price, because as the real price goes up, it reflects operating margins for the miners. And if their costs are behind the increase in the bullion, or their costs are lit on them, then profitability comes back into the gold industry. And this is how Mother Nature works in a post-bubble contraction, whereby that contraction is the word, when credit contracts, and it does, and liquidity disappears for everything. So what happens is Mother Nature raises the real price of gold, the miners increase their production rates, and exploration guys find more of it. And despite what the crazed central bankers think about gold, it comes into the banking system and starts to re-liquefy the whole system as all of these contrived credit instruments are crashing. So Mother Nature runs a very good ship.
Yep. And on that note, Bob, just tell us where we find your work and how we can subscribe to your service.
Yeah, sure. It's institutionaladvisors.com. But with the magic of the internet these days, if you just Google my name, Bob Hoye, Bobhoye, bang, you're in. And the way we work is we can put you on a regular mailing list for 4 or 5 weeks. If you like it, you can come in on a subscription. If you don't, that's the way it works.
Yeah. Hey, and you'll find the link in the show notes to this interview on financialsurvivalnetwork.com. And it's going to really be interesting in these months ahead as these markets have gotten so distorted and so malinvested. And once the word is out and once they seek equilibrium, it's going to be hell to pay, isn't it, Bob?
Oh, yeah. No, here's the other one. I think that now I watched the Gallup poll on the presidential approval of Obama, and it's still up there at 44%. It has to get below 39 to break down on the chart. But as the financial markets roll over, it will take Obama's polls down with it, and then I think you can get some really tough criticism from the opposition, political opposition, in this case the Republicans. So,
or what's left of them. What's left of the Republicans?
Well, they might find some backbone when the polls turn against Obama, and I really believe that you get a bear market in here, and his polls are just going to evaporate.
I agree on that. Thanks so much, Bob. We'll talk with you again soon.
Always good.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next